today.
Okay, Rudy here, 1st of January. Welcome to a special edition, a retirees income stream session, looking at interest rates, dividends. So whether you're already an existing pension person or you're looking at setting up a pension, what are your options? So to begin, we'll start with interest rates. So this is the Australian 1-year government bond yields. So 3.97. So the trend, or this is my macro outlook, is for higher interest rates going forward. Obviously short term driven by inflation, and longer term just for trying to attract money. So 1-year rates are up, 5-year rates are up. If you're new to the channel, declining channels, wedges when broken are bullish. Like if this was a share, that was a buy on this breakout and a retest, and we're now having another breakout. The 10-year yields, they're about to break through a key support resistance level. Aussie 30-year yields are going up. So going forward, you need to weigh up the dividend you're getting with the risk capital. Now, a popular ETF for income streams is the old VHY. Biggest weighting is BHP. Don't know why, because he's not the highest dividend. And then basically all the banks and Telstra. So VHY's current dividend yield is 4.3, and take off their management fee, so you're close to 4. So my goal when I go through the preferred dividend stocks is to have at least 6, which means 50% more income than this guy. So BHP, again, if you have watched the videos, I'm resource bull, but this is for retiree income streams. So 3.8%, so it's not the greatest of dividends. I would buy it for capital growth though. Then we got CBA. So again, current div is 3. For all the longer term pension people, we probably bought him a long time ago, and he's based on your purchase price, giving you a good yield. But if you were to cash him in and switch to term deposits, you'd probably get a higher yield with less capital risk. I'm not overly bullish, not overly bearish on the banks. I don't think they're going to do very much. NAB. So NAB's a div of 4 and the PE of 20. Well, that's the other thing, is CBA's still very expensive. PE of 27. Westpac 3.9. You can see I think they're just going to be topping out. I should go back to NAB and look at him too. So I just think they're going to struggle at these levels. If you are going to buy a bank, probably ANZ. He's div of 5.9, only 70% frank though. Again, I just can't see them shooting the lights out. Telstra, the old dividend favourite, but his div's currently on 3.9, PE of 26, so he's not a bargain. Again, I can't see shooting the lights out there. Okay, now before we go into my chosen ones, I'm not going to be putting things like this guy in here. Even though his dividend's 10, Treasury wines. I know some people love it, but we're not going to buy something because its dividends high. So just to get that out the way. All right, so in alphabetical order, so ALX, Atlas Arteria. We'll just go to a weekly chart. So their toll roads 8.2%. That's the other thing too. If you're in Australian super, you can create your own ASX 300 share portfolio. The current sort of crediting rate is about 8% that you get in their investment option. So you can set up a dividend portfolio that gives you 8, including franking credits. So that's basically a 5%. So if you get a 5% div, get a 2 or 3% franking credit. There's your investment return, and then any capital growth exceeds the option. Anyway, enough of that. Next one is Acro, ACF. So in the scaffolding business, 5.7 fully franked, P of 14. Anyway, Bell Financial Group. So div 5.3 fully franked. Financial services growing, so a PE of 18. You're paying for some growth there, but a lovely chart pattern. We've got Beach, so oil and gas. I've got little notes here if you can buy them in Super, because they're only ASX 300. 7.7%, only 33% frank though, but it's an option. Cash converters, so 6.1 fully franked. So they've had their days back in the time, making a bit of a comeback. Chart looks great. CUE, so oil and gas, 13% div. No franking though, but you don't need that. Dicadata, DDR. Now they're only 4.3 fully franked, but I just like the space. Wholesaler to all the big corporates, governments need to get all this new AI technology. And the chart looks wonderful. DBI, so coal terminal, 5.7, 67% franked. Fortescue, he just scrapes in at 5.0, fully franked. So iron ore miner. Fleetwood, FWD, so 9.4, fully franked. Accommodation manufacturer, so they're like bouncing off support there. GR Engineering, so their div just scraped in at 5.0. Probably a better buy back here, but they're still at 5 and looks like they're going to go on with it. Got Horizon Oil, so they're 14% div, no franking credits though, but a nice steady looking chart there. IVE Group, so they're marketing visual communications, div of 6, fully franked, P of 10. Looks pretty steady. JMS, so they're 5.4 div, no franking though. They basically got a share of a manganese mine, an old resource. So a lot of resource stocks have got buys because that's what I talk about. Lindsay, so trucking, 5.5 fully franked, just breaking out of a nice declining channel. Macmillan Shakespeare, so 8.7 div fully franked, so there's salary packaging, nice action there. Then we got New Hope, so coal, 8.6 fully franked. We got Origin Energy, so 5.0 fully franked. So fully franked, yeah, you get those franking credits. PFG, so another financial services type business, 6.9 fully franked. Shaver Shop, so this one was an old share from Mr. Billy. He comes up with some good tips, old Billy. So Shaver Shop, retailer, so 6.8 div, fully franked, lovely chart. Tower, so this is an interesting one. So general insurance, 12% div, no franking, and PE is only 9, so they're not expensive, and the chart just keeps going up. Then we got Waypoint. Not a great fan of property trusts, listed property trust in a rising interest rate environment because it's negative for them, but these guys don't seem to have been impacted. Portfolio of service stations, 6.4%, no franking though. We've got WAM. So WAM 10.8%, 60% franked, 9 PE. So that looks pretty attractive. Doesn't look like it's going to fall over. And then we finish off with the King. All you really need to do is just buy this guy and retire. 7.3% fully franked. They aim to increase their dividends by 50%. The last few weeks have been backing up the truck on the channel. Alright, so that's your dividend options. I hope that helped. If you've got any other dividend ideas that don't look like Treasury wine, please share. Okay, see ya.